afternoon, ladies and gentlemen. A very warm welcome to you on Market Guru, our special show where we get you to meet the finest brains on Dalal Street, individuals and professionals who have navigated bull and bear markets over the last 3 or 4 decades and have created substantial wealth for their clients, not only for themselves. Our guest today is Mr. Maneesh Dangi, CEO and founder for Mosaic Asset and Management, a very well known market guru who has been observing and investing in Dalal Street and overseas over the last 3 decades. Namaste to you, Manishi, and a very warm welcome, sir. We've had a very smart rally on Dalal Street over the last 2 weeks or so. Is this a dead cat bounce, or do you feel that the underlying sentiment has changed for the better in India?
Hi, good afternoon. As we were discussing before the interview, my sense is that one is a little bit of um, m- some kind of a reversion in play. In some sense, markets positioning, at least in near term, had become too skewed. Too much of mandi was being played, and to that extent, at least in short term, you could imagine these tactics would play and markets would revive. But taking a step back, there are a few positives and few negatives. Very, very quickly, India's sort of disappointment cycle may have run its course. So in terms of earnings and economic
Okay.
growth slowdown, both sort of may have run its course. So market expectations with respect to corporate earnings, as well as market expectations with respect to growth, local growth, that is, you know, have had sort of a lot of disappointments in last 12, 18 months. I think at margin, for us to be disappointed with it after such a long spell of relatively weakish setup, I think the probability of that is low. So that is one way to look at, so if you sort of are micro, then you would begin to think that, okay, the local conditions are improving at margin and therefore it's turning bullish. But if you moment you sort of contextualize vis-a-vis the global setup, I think the uncertainty levels have risen and for good now. And as I was telling you that, I kind of liken this to an economic world war, today. The tariff war, capital war, trade war, this is going to kind of continue for a while. And to that extent, I think it's a trader's delight that markets will be so volatile. But at least for the investors, they'll have to be dealing with a lot more volatility than they're used to for very, very long time.
Fair point. The fact that the disappointment cycle has run its course is a very positive and welcome change in outlook on Dalal Street. Manishi, as all of us have experienced a tremendous amount of pain over the last 7, 8 months or so, I'm sure this is as welcome a relief as sometimes rains are in Mumbai. So, with that background in mind, Manishi, one more question I wanted to ask was this. Savage correction in the IT space. Software hasn't somehow been in the best of books as far as equity strategies such as you are concerned, and earnings have also disappointed, at least from top two players. Is again the worst over for IT companies, or is there more pain ahead?
So there are two parts to it again. One is if because IT is driven by Nasdaq, and the valuations of essentially US markets. That squeeze it has been pretty substantial over last few months, and so to some extent, I don't think the IT's performance as such. Of course, there's been a disappointment. Explains the significant stress that we've seen in terms of IT's performance in India. It's mostly to do with what has happened in US. So lesson there, of course, is that you can't ignore US. It's 70% of the market, and let's say in IT, it's a very large 50-60% of what IT sells is actually to US markets. So one valuation has been driven by uh, course correction in the US equity, more specifically tech equity there. And two is that it's also a good proxy of US economy. And so, you see uh, all of these surveys which talk that, how much of a consensus it's become amongst fund managers that, US may end up having a sort of a hard landing of sorts this year. So that's another issue with respect to IT, that, it's a US economic slowdown, and which in turn is also related with US equity actually selling off substantially. So IT is most adjacent to it. And so to that extent, it's been a disappointment. I think from an earnings standpoint, I still, given where we are at this stage, if US were to slow down more dramatically than what markets are anticipating, because bond markets are not yet telling you that US is actually entering in recession. But if it were to enter in recession, it could hammer some of these sectors which are more proximate to US economy, I would say. So in a sense, course correction in terms of valuation has happened. It's a reasonably, from a structural standpoint, it remains the most prominent sector in India. So for a longish bet, it makes sense. But again, from a business cycle standpoint or a market cycle standpoint, the near-term uncertainty actually in last 1.5 months has actually risen in IT, than what we all anticipated. Mostly to do with the tariff war, but also to do with the fact that markets have gotten corrected substantially in US.
Fair point. Manishji, let's talk about some things where a little more groundwork is done, and they look brighter as far as the Indian horizon is concerned. After a very long while, we are seeing record highs on HDFC Bank and ICICI Bank. Bank Nifty has followed suit, and that is because of two rate cuts, additional liquidity in the system, and as you very rightly point out, the disappointment cycle running its course. For these two banks, for the banking sector in particular, and also PSU banks, are the good times here to stay, sir?
So basically, again, banking in India is a very, very local business, and to the extent it is sort of farthest, if not the farthest, actually very far from US economic cycle or world economic cycle. Given that Indian balance sheets are clean, and the NPA cycle has not even perked up in a meaningful fashion, and as you rightly said, that the liquidity has improved dramatically. Rate cuts have come in. Bond yields have actually rallied quite substantially in last 6-12 months. And all of that actually augur well for BFSI. Also remember this, that BFSI, generally speaking, in most market cycles, is the first cycle to catch the bull sense. So if you are a bullish, you have to begin with the BFSI. Especially in the context that we are so different from what we were in 2015-16, when the NPA cycle was pretty deep. So I agree to this general thesis that at margin, I would say that banking would surprise positively, because the NIMs had actually gotten squeezed a lot in last 2-3 years of tight liquidity, 2 years of tight liquidity. I think a little bit of a relief sort of underway there. And some of the stress in terms of underperformance, even in the stress sector like microfinances and all, has gotten priced quite substantially, Shailaji. So to that extent, I think there could be a little bit of a sort of a positive cycle underway there.
Sir, you mentioned that for all those people who are bullish, the banking cycle and the NBFC cycle is the first to turn. I'm just very gently checking. Are you bullish now?
So at a market and an aggregate, as I said, it's a trader's delight. I think. I think so. In September, we discussed that for 3 years, equities won't deliver even FD like returns. My sense is that now for 3 years, most probably equity will deliver 2-3% over FD. Okay, so because FDs are delivering 8% to you,
Okay.
10% is, in my assessment, given of course that markets have fallen by 15 odd percent, in aggregate 20 odd percent actually, if you look at a larger market.
Yes.
So basically now I can't make an argument uh, after 6-8 months that it will still deliver just FD. But it's just that it won't deliver as much risk premium as you want. Given that I am also contextualizing that the volatility in next 6, 12, 18 months will be higher than what we experienced in last 5, 10 years. So basically, buy pessimistic stories and sell optimistic stories. So it's a trader's delight. Is that see market transition from bull markets to bear markets to being trader's delight to bull markets again. So my sense is that we are in a little midst of a that setup in which it's a trader's delight. High balls, a lot of squeezes on both sides, upside and downside. So if you are आपकी नजर अगर पैनी है on the market, there's a reasonable way to bet money in these markets. But with strict stop losses. But again, I have to sort of I have to be very careful that lot of equity investors who come in with a 5% risk premium assessment that equity will deliver 4-5%, right? If I were to tell you that equity will deliver 9-10% over next 3 years, I don't think you will be happy with that. Because generally you would want 5% more than bonds.
Yes, let me rephrase the statement. You may not be bullish, but you are certainly not bearish.
Yes. So as I said, see, bullish bearish sentiment, it depends upon the risk premium available on asset class. Let's say I'll tell you something that I'm very bearish on today. Purely from a valuation and setup standpoint,
Yes.
is let's say gold. Uh, Gold has become extremely expensive.
Okay.
On inflation adjusted basis, when you were born, gold was actually, because I know your year you were born, gold was actually in a hyper bull market, and for 20 years gold didn't deliver anything. My sense is that, and of course, gold has gotten to that point of price yet again. So my sense is that for next 10 years, uh, at least for an investor, he should be underweight gold now, even though the consensus view is that it's becoming a consensus view that, let's sort of buy gold because gold has done, as we know that 20 years, in last 20 years, gold has done more than equity in India. So my sense is that I'm bearish there. I'm bullish on bonds even today, which basically means that you will earn more than what bonds are promising as a fixed return. 10-year bond at 6.5 will still most probably will deliver 9-10%. So basically, I'm still making a point that a 10-year bond, not the FD, but 10-year bond, because there will be capital gains, LSG. So you will earn as much as equity. Okay. And then equity, I'm saying that instead of 5%, you will make most probably 2-3% over what you would otherwise have got. You expected 5% risk premium in equity, you will get 2-3% more. Is it bullish or bearish? And with a lot of volatility, so you can trade markets well now on both sides. So again, very, very near term. Okay, if you were to tell me very
Okay.
near term,
So
last point, very near term. If I were a trader, I would sell rallies now. In a sense, because I kind of
yes.
I think that the markets will move in range. So just in very, very near term, I'll sell rallies now. But again, that's a little bit of a dealing room headset. That your audience perhaps is not the one which is watching us to listen to the dealing room headset. But I'm a dealer also. I've done it for 15, 16 years. So in a sense, I need to watch markets on both sides.
Uh, Manish, you would be surprised to know, and pleasantly so, how much of demand for quality views there is for gold. And as you know, and as everybody is hearing the drum beats of 1 lakh rupees a tola, your advice is very, very well taken that this rally should be sold into. Gold has appreciated about 30, 34%, 35% over the last 1 year or so, and it shows no signs of abating. Probably this is the final hurrah that we are seeing. Let's hope that people don't burn their fingers. So we've been cautious on gold. We are thinking in terms of a trading opportunity for the next 18 to 24 months, and of course there is the structure of equity seems to be improving a bit. Now let's come to the PSU pack, Manishi. The disappointment cycle ended pretty early in the PSU packet probably a month earlier than the markets that have rebounded very sharply. Do you see PSUs as a homogeneous sector now, which offers value because of margin of safety? Or again, should we be very careful of these bounces here?
So I kind of think of PSU back in three parts. One is banking. I think, that's a beta trade, that if banking does well, PSU does well. Second part of PSU is a utility basket, which is essentially a good cash flows, high integrity, good quality cash flows. And so therefore that's a bond trade, because when rates go down, they do very well. So that part, of course, should do decently. Any utility business, think of PGC, it's kind of a bond only with a little bit of a growth built in. And then the third part of the PSU, I kind of think as a manufacturing bet. Okay, that is the one, which I've kind of argued against over and over again. And I think I would say still argue against it. I think the threat of China is real. The exuberance of Indian manufacturing revival is not totally untrue, but lot less truer than what it is. One second. So this is the third part, Chief. That the manufacturing bit is where I would be still concerned about. So constructive on banks, uh, PSU or private, then utilities businesses, and but less constructive or rather still bearish on the manufacturing PSU.
Okay. Coming back to private banks, when you read the documents provided by ICICI Bank and HDFC Bank in terms of business growth and how the last quarter panned out, are you hopeful that the economy is turning around for the better? Why would the Bank Nifty otherwise hit a record high?
No, equity has got a durbin, right? It doesn't see what it is right now. It's got a telescope to see the future. And as I said, if you study last 25 years, all bull markets begin with BFSI. So essentially, if local economy were to bet on one sector which you think, would actually be the harbinger of the new rally, let's say, a new bull market, let us say, if it were to begin in 2026 or 27, whenever it begins, I think the first signs will be seen in banking. So to that extent, markets are right. It's also a defensive play. How do I secure myself from, stay away from China manufacturing threat? How do I secure myself from US economic slowdown? You want to look for something super local. And in super local, frankly, you end up, almost 60-70% of the super local business in India, which has got no relationship with the rest of the world, at least at the first order level, is actually banking. And so, to that extent, it is not that the economy is accelerating from here. It is just that the economy has stopped incrementally slowing. The GST data, the PV sales data, and many other data points are suggesting that there is a upcycle underway. Mild one, but upcycle underway. Contrast this to what is being anticipated in US, where the down cycle is underway. So to that extent, I'm wearing a headset of a fund manager and actually doing a incremental asset allocation. My general point will be that, okay, let's buy something which is not very expensive and is away from China and US threats. That ends up being a little bit of a banking thing. And plus, policy support now is in place that I know. RBI's cut rates, RBI's eased liquidity. You may look at HDFC, they've cut sort of all of these banks are cutting the savings rate even further to 225 and so. You can easily get in arbitrage fund or a liquid fund 7%, 8%. But these guys are actually cutting rates further. So that basically is opening themselves up for a little bit of an extra room to improve their margins.
Right. So we agree on that there are green shoots emerging in the economy because the pace of slowing has stopped, and there seems to be decent green shoots in the private banking sector, followed by the PSU banking sector. This much we are very clear about. How about bond yields now? Manishji, you are a past master at tracking bonds, and as all of us know, gentlemen prefer bonds. How do you see the bond market at this point of time? Is it pricing a recovery in India?
No, it's still not. It is pricing a sort of significant easing. That basically equity second order bonds have to price lower rate cuts. Lower rates, and equity has to price that the lower rates eventually will enable the economy to recover. So it's second order. You get my point. The first order is that the bonds are saying that economy will need lower rates in India, and bonds are cherishing the part that even when US is slowing, US dollar is actually not appreciating. Okay, which by basically means that the INR is not depreciating. See, so basically, what happens is that every time US slows, because INR depreciates, it sort of stunts our ability to cut rates substantially. Very difficult to cut rates when INR is actually seeing a sell-off. That's the way the policy works. But because in this cycle of US economy slowing, INR is actually, in last 1 month, you've seen INR is actually stable or appreciating, right? So that gives a lot of room for RBI to cut rates. And which is the point I made a couple of times in the past also, that rate easing cycle in this market, in this economic cycle will be deeper. Okay. And to conclude, the answer, of course, to your basic simple question was, does bond yields have more headroom, legroom, to sort of on a 10-year bond will essentially mean that the 10-year bond makes 10-11% returns to you. So, which is sort of versus FD and others, there are capital gains there. See, generally people think bonds are like a boring subject, they don't deliver well. But in when when economies slow down, bonds like. And so bonds are responding to better policy setup, are comfortable with currency being stable, and are now pricing in that RBI will have the wherewithal to cut rates sharply so that we can rally all the way to 575, let's say. In a 12 months time, let's say, in April, when we're discussing next year, hopefully, we will be lower than 6%. And which basically means that bonds would have delivered, a simple 10-year bond would have delivered 10-11% to you.
Are you saying you're looking at 10-year bond yield at 5.25 in 1 year from now?
No, below 6%. So 575 to 6%, I said. Below 6%. But below, just a 50 basis point rally is sufficient for you.
Okay.
See, again, you think last 12 months, even when equity was struggling, bonds would have delivered you 11-12% returns. 10-year bond. You know why? Because, we move, see, in last,
Yes, sir.
when we move by 100, when we move our rates by 100 basis point lower, you basically make 7-8% capital gain over and above the 7.5% of carry. So 15% return in a 100 basis point rally. I am anticipating a yet another 40-50 basis point rally, and that basically means the bonds may end up delivering near 10% return.
Yes, I've always said that gentlemen prefer bonds, and the Indian markets are now, of course, deeper than what they were about 10-12 years ago. So there's good money to be made. I remember, I think a year ago when we spoke, you had mentioned that a triple rated bond fund would perhaps be one of the best things to invest for over the next 2 years or so. Be that as it may, Manishji, against the backdrop of what all we've discussed, what would be fresh allocation to equity at this point of time in April 2025? Do you see H2 better than H1? Do you see a good monsoon? Do you see an earnings cycle reviving? And do you see FIIs coming back in?
So many questions. So basically, will earnings revive? My general sense is that, we will grow at 6% or thereabouts, 4% of inflation, so 10% of nominal GDP growth. I think we should be able to deliver 10-11% of earning growth. Markets are anticipating about 13. So a little bit of a disappointment, a lot less than what we've had in last 12 months, but very little. Okay. Number two is that will FI return? Basically, we've never seen that in equity market sell-off in US, FI generally, one, have home bias, two, basically they get out of most emerging markets. Even though I accept that this current setup is a little different because INR may not depreciate in this cycle, but generally it would not be wise to bet on FIs returning in a meaningful fashion. Third, whether the monsoon will be decent. I think, whatever we hear from the IMD and others, likely that the monsoon will be decent. So I will bet that, India does not cyclically get slower from here. and I'll bet that policy in India will be reasonably sort of supportive. But I also bet in India that I also bet that global market setup will remain turmoilish, and to that extent the volatility will be substantially higher than what we all used to.
Right. Manishi, we'll call it a day and take this discussion forward on something stronger in terms of brew. Till the time we meet again, here's wishing you the best, and here's wishing everybody in the markets uh, a better 2025, given the fact that the last 8-9 months have been very, very painful. Thank you for your time, and I hope you enjoyed it as much as we did.
I do. I always do. Bye bye.
Bye-bye. That, ladies and gentlemen, was Mr. Maneesh Dangi, uh, the CEO and founder of Mosaic Asset Management. He's bearish on gold. He wants you to be very, very careful. Gold seems to have run up much too sharply in too short an interval. He's hopeful that 2025 will be a trader's paradise, even a little ahead, maybe 1 or 2 years, given the fact that volatility in the market has gone up dramatically compared with the last 3-4 years. He's fairly bullish on the banking space and the NBFC says. He says that these are sectors which herald a new bull market and are the first to turn towards the positive. IT still remains a bit of a black hole, nothing much is known about that. And of course, the manufacturing base of India will face enough and more problems from the Chinese part, and that bonds, 10-year bonds, might be one of the best places to be in terms of safety and higher returns. I hope you enjoyed the conversation as much as I did. Thank you for watching. Remain glued on Business Today Television. There's a lot that's happening on the other side of the